You finally saved your first $20,000. It took discipline, it took time, and now that money is sitting in a checking account, completely paralyzed. You know you should invest it, but the fear of making a mistake keeps you from touching it. So your cash sits there, peeling away. The culprit is inflation. It acts as an invisible tax on uninvested cash, chipping away at the actual value of your money every single year it sits idle. This line chart illustrates the problem. Look at the top line. Your $20,000 balance stays perfectly flat, but the declining line below represents your actual purchasing power over a 10-year period. A few years ago, your regular coffee order cost $2.50. Today, that exact same cup of coffee is closer to $4. Your money simply buys less of the world than it used to. Investing is the only mechanical fix for this erosion. It puts your capital to work, generating growth, while simultaneously shielding the wealth you already built from inflation. Keeping $20,000 in a standard bank account results in a steady loss of purchasing power. To maintain the same standard of living over the next decade, your capital must grow fast enough to outpace these rising costs. To invest confidently, you have to shed the idea that the stock market is a casino. When you buy a stock, you are buying legal ownership of a tiny slice of a real operating business. Take a globally recognized hardware company like Apple. This is a physical entity with massive storefronts, a complex supply chain, and millions of daily customers. If the company executes well, if they open new locations, sell more phones, and increase their annual revenue, the underlying business becomes more valuable. Because you own a slice of that business, your slice becomes more valuable too. Your money grows because human productivity, corporate expansion, and global commerce are actively working on your behalf, even while you sleep. Before you deploy a single dollar into the market, you must pass a strict diagnostic test. Skipping these prerequisite steps often leads to unnecessary financial risk. This flowchart outlines your operations. First hurdle, high interest debt. Clear it immediately. Paying a 20% debt provides a guaranteed 20% return. Next is your emergency fund. You need 3 to 9 months of living expenses in an accessible savings account. This cash acts as psychological armor. When your car breaks down or you lose your job, this liquid safety net ensures you never have to panic sell your long-term investments to cover a short-term crisis. Investing your cash while carrying high-interest debt or lacking an emergency fund is like pouring water into a bucket with holes in the bottom. You cannot build wealth until you patch the structural leaks. The final prerequisite is checking your workplace benefits. If your employer offers a retirement scheme where they match your contributions, you take all of it. An employer match is completely free capital. It offers an immediate, zero-risk, 100% return on the money you contribute before it even hits the market. Once you capture that match, house your investments inside a tax-advantaged account like an ISA in the UK or a Roth IRA in the US. Capturing free employer capital and legally shielding your gains from taxes allow your money to compound faster without requiring you to take on any additional risk. With your foundation secure, you now have to decide where to deploy the rest of your $20,000. For beginners, this usually comes down to property versus the stock market. Real estate is a traditional wealth-building path. It's tangible, and you can leverage debt to buy it. But saving for a deposit takes years, often locking out early investors. This matrix breaks down the options. Property carries immense friction. High barriers to entry, maintenance costs, taxes, and tenant responsibilities. Stocks offer instant liquidity and allow you to invest with very small amounts of capital. For a beginner starting with exactly $20,000, the stock market offers a drastically superior effort to predictability ratio. Real estate often functions more like a second job. Modern stock platforms allow for true passive accumulation. Once new investors choose the stock market, they usually make their first major behavioral error, trying to pick the next hot tech stock based on what performed well over the last few years. Past dominance tells you absolutely nothing about future survival. In 2010, Nokia was the undisputed leader of the mobile phone market. They owned 37% of the global market share. Within 10 years, that share plummeted to under 1%, and the stock lost nearly 70% of its value, wiping out anyone who assumed a past winner was a safe bet. Look back to the 1980s. The largest, most stable companies on Earth were industrial and manufacturing giants like General Motors. By the early 2000s, the landscape rotated, and the market was ruled by traditional energy and retail corporations like Exxon and Walmart. Today, those titans have been largely replaced by tech leaders like Nvidia and Google. Concentrating your $20,000 in one specific company creates a catastrophic single point of failure. You are betting your entire financial future on your ability to predict exactly which global empire will fall next. The easiest way to neutralize that risk is to buy a broad index fund. Instead of trying to pick the winner, one purchase buys you tiny slices of thousands of companies across the globe. An index fund is self-cleansing. When a company fails, it drops out of the index. When a new company rises, it gets added automatically. You get zero-effort, permanent diversification. This automated stability allows you to unlock compound interest. This is when the returns you earned on your initial investment begin generating their own returns. This bar chart mapping the compounding snowball models the exact math. If you invest $1,000 a month at an 8% annual return, it takes about 7 years to reach your first $100,000 milestone. Because your pile of money is now larger and earning its own interest, the second $100,000 only takes 4 years. The third takes 3 years. Eventually, the timeline compresses so much that you add a new $100,000 almost every single year. This first $20,000 serves as the catalyst for the entire mathematical curve. Delaying the start makes reaching those later, faster milestones significantly more difficult. As you start investing, beware of early success. It is very easy to experience a lucky week in the market, confuse it for financial expertise, and start taking reckless risks. If you choose to trade individual stocks, quarantine that activity. Trade it as fun money. Keep it to a tiny fraction of your portfolio that won't ruin your life if it goes to zero. Above all, do not materialize your losses. When the market inevitably dips, your portfolio will show a negative number. That loss is entirely theoretical until you hit the sell button, locking in the damage permanently. Broad market indexes have survived the Great Depression, the dot-com bubble, and the 2008 financial crisis. Investors who simply held their positions uninterrupted through the panic eventually recovered and grew their wealth. Optimizing your first $20,000 requires a pivot away from excitement and toward automation. A boring, consistent system protects your wealth from your own worst impulses.